Hi, I'm Ryan, and this is Market Lab. The Fed's been in the news a lot lately and is getting the credit for a lot of the shakiness in financial markets. In this video, we're going to walk through the Fed and its capabilities, as well as to discuss the impact on the real economy and investors. All right, let's get into it. The Federal Reserve is the central bank of the United States. A central bank is an institution that manages the currency and monetary policy of a country and oversees their commercial banking system. All developed nations, sans Monaco and Andorra, have central banks, and they play a vital role in the economic security of a nation. Central banks have mandates that influence the policy decisions they make. In the case of the US, the Fed's mandate is to maximize employment, straightforward enough, stabilize prices, mostly protecting citizens from high inflation or deflation, and to moderate long-term interest rates. Important since high rates can do bad things like choke off economic growth and make home ownership unattainable. The first two objectives are sometimes referred to as the Fed's dual mandate. The Fed has a number of policy tools to influence financial markets, such as setting the reserve requirements that banks have to set aside in cash or deposits at the Federal Reserve Bank, or the discount rate, the interest rate it pays on deposits that banks hold at the Federal Reserve Bank. We won't go into everything, but the two main ones that are relevant at the moment are the federal funds rate and quantitative easing. The group responsible for these two policy tools is the Federal Open Market Committee, the FOMC. The FOMC is a committee within the Fed and consists of 12 members, including the chair of the Fed, this guy, the 6 members of the Board of Governors of the Federal Reserve System, including Lil Brainard, which sounds like a cool rap name, and 5 presidents of the various regional Federal Reserve banks. New York always has a spot, but the 4 other ones rotate annually with the 7 other regional Fed presidents. And while I was making this video, this guy resigned after pulling a Pelosi. So yeah, feel free to send in your resume, they're hiring. Anyway, they hang out here, which is perhaps a throwback to the gold standard. The group meets 8 times per year, and following these meetings, the FOMC publishes a statement on their website, usually around 3 weeks after the meeting. For example, the January 5th press release is from the December 15th meeting. These statements outline their views on the state of the US economy, provide any new changes to policy, and increasingly provide guidance on where they see the economy and policy shifting in the upcoming years. In their policy statement, the FOMC sets the federal funds rate, which is the target rate that commercial banks can borrow and lend to each other overnight. Thus, it is sometimes referred to as the overnight rate. Basically, when banking hours are done, at what interest rate can a bank borrow to meet its reserve requirements or lend out from excess reserves? This rate is a target range and says what level they would be satisfied with banks lending at. They don't actually force the banks to this level, but rather borrow and deposit their own money so that the market rate settles within this band. This rate isn't changed very often anymore, so when it does, it's usually noteworthy. Mostly just because finance people are sort of jumpy. And surprise rate changes are usually the result of sudden dramatic changes to the US economy, and usually result in significant volatility in financial markets. The Fed also provides pretty good guidance on where they see rates moving in the future. This primarily comes in the form of the Fed's dot plot, where they poll the FOMC participants to get their projections on where they see rates going over the next several years. When short-term interest rates are either at or approaching zero, the normal open market operations of a central bank, which target interest rates, are no longer effective. This was the case during the Great Financial Crisis and again during the COVID pandemic. Instead, a central bank can target specific amounts of assets to purchase. They go out and buy bank debt, mortgage-backed securities, the odd corporate bond, but most importantly treasuries, like government bonds, which, as you can see here, they did a lot of after the financial crisis, and even more during COVID. In basic bond mechanics, buying pushes the price up, which has an inverse effect on the yield. Basically, they buy stuff to keep interest rates low. This keeps rates low for corporations, homebuyers, etc., but also importantly pumps new money into the economy, which seemingly should be used for consumption and help the economy rebound. However, when they start to unwind these asset purchases, as they are intending to do in 2022, it will of course have the opposite effect. Alright, so that's my quick summary of the Fed. For some additional color on the current situation and why they're always in the news lately, please check out my follow-up video, What's Going On with the Fed. Also, if you enjoyed this video, please consider giving it a like. I'm Ryan, and thanks for tuning into Market Lab.